Hello everyone, welcome to our video cast of our monthly wrap-up. It's the first one we're doing, and it's just a different way of us communicating with you and hopefully just giving you some insight into our thoughts of what has happened and most importantly what our expectations are for the future. So 2018 was a terrible year. Local equity markets were down over 8%, the local listed property market was down over 25%, and global markets were only slightly positive in rand terms. This meant that in a long-term focused balanced type portfolio which has all of those asset classes in it, the returns for last year were pretty weak and often even negative for the year as a whole. Our message to investors was to remain focused on your long-term strategy, and the long-term strategy can't be in cash because cash over the long term is going to underperform inflation. And the good news is we're reporting back now on the first quarter of 2019, and we've seen the markets turn around quite nicely. The local equity market is up, international equity markets are up over 12% on average over the first quarter, and even the listed property market is slightly positive over this first quarter. That's resulted in us seeing returns on long-term focused portfolios of between around 4 and sometimes over 5% in the first quarter alone. That is a better return than we saw in the whole of 2018 from balanced type portfolios, long-term focused portfolios. We're seeing at the moment a lot of value in local equity markets. We're also seeing the economy starting to improve. Over the 5 years prior to 2018, the average growth in South Africa was less than 1%. The forecast for 2019, even with the challenges of load shedding and the nervousness prior to elections, which is quite normal actually, economic growth returns are expected to be possibly even double what we've seen in the prior 5 years. And that is an indication that we're on the track of recovery from an economic growth point of view, and that will ultimately feed into the equity markets and then affect portfolios. Our expectations for a long-term balanced portfolio is that it would give you returns of between 3 and 5% above inflation. So in absolute terms, around, let's just call it around 10% probably on average. We haven't seen that for the last 3 to 5 years because of the mess that we've seen in the local stock market. We're starting to see that improve, and we expect that to improve and feed through to portfolios. I hope you found that helpful and it's given you some insight into what has happened in the markets and our expectations for the future. If there are any specific questions you may have around your portfolio or things you're worried about, by all means get hold of us either via email or just give us a call. Thanks for watching this, and we'll see you again next time.